Hello guys, I hope you will be fine. Today we are going to discuss some practice questions and our topic is concepts of financial accounting. If you want to watch lecture video, I will provide the link of the lecture video in the description of this video. So in this video, we are going to discuss some practice question. So here we go. First question is about the users of financial statements. Okay, as we know, there are different users of financial statements. We have investors, shareholders, we have lenders, regulatory authorities, customers, suppliers. So all these are your stakeholders. So the first question is the financial statement included in the annual report. We know, guys, in annual reports, we have a set of financial statement which might include which includes actually the income statement, statement of comprehensive income, balance sheet, which is also called statement of financial position, statement of changes in equity, disclosures, statement of cash flows. So this set is called annual reports. So the financial statement included in the annual report to the shareholders are least useful to which one of the following. Here we have a list actually. From this list, you have to select the answer. Like financial statements are least useful to which one of the following. Stockbrokers, guys, stockbrokers, they are heavily relying on the financial statements. So we cannot say they are the least users of the financial statements, because stockbrokers, they have to advise to their clients based on the financial statements are based on the predictions. So competing business, yes, competing business is also they are also heavily they are also interested in the financial statements. The reason, as a competitor, we are always interested to know about our competitor, how much profits they are earning, or whatever their assets they have. So they are not the least users. Managers in charge of operating activities. Yes, actually, this is the answer, because from this list, managers in charge of operating activities, they might be the least users. Reason, because managers will say internal stakeholders, right? And for managers, uh, because they want to take decisions about the future of the business. So for them, management accounting is more relevant, not the financial accounting. So that is why for financial statement, managers in charge of the operating activities might be the least user. Bankers preparing to lend money. Obviously, if you are a bank, before lending the money, you have to think about the recoverability of your money, right or wrong. So they will check the financial statements of the borrower. They are also interested to see either this borrower will return your money or not, right? So bankers, they are also heavily relying on the financial statement. So it means from this option, managers in charge of operating activities might be the least user. Okay, the reason, because for them, management accounting is more important. This is the answer. Then we have a next question. Which basis of accounting is most likely to provide the best assessment of an entity's past and future ability to generate net cash inflows? So you have to select which basis of accounting, okay, which can be used to assess the entity's past and future ability to generate net cash flows. So guys, accounting here, obviously it is based on different concepts. So here they are telling you first option is cash basis of accounting. No, accounting, fundamentals of accounting is not a cash basis. Accounting is always done based on accrual basis. In accrual basis, we know revenue and expenses we record at the time of transaction, okay, or at the time of earning process is complete for the revenue, and at the time of increase of expenses, regardless we have received the cash for revenue, or regardless we have paid the cash for the expenses. So cash basis of accounting is not the fundamental of financial accounting. So tax basis of accounting, what is a tax basis? First, let me explain what is cash basis. Cash basis mean to say you will record only those transactions which includes cash inflows or outflows. Accounting is never based on cash basis. Accounting is always based on accrual basis. Second, we have a tax basis of accounting. Obviously, tax basis mean to say tax authorities, the rules and regulation which is followed by tax authorities, that is called tax basis of accounting. So Financial accounting is not based on tax cases because tax rules are different, financial accounting rules are different. So accrual basis of accounting, yes, accounting is based on accrual basis of accounting. So then we have this is actually the answer. Then we have a modified cash basis of accounting. Guys, modified cash basis of accounting mean to say some transactions are recorded based on accrual concept, some transactions are recorded based on cash basis. And usually this is followed by governmental accounting. So there are certain funds accounting are there. There we follow modified cash basis of accounting, but it is not the fundamental basis of financial accounting. So option C is correct because this is the basis of accounting which we use to assess the entity's past and future ability to generate cash inflows. Then we have a next question. For financial reporting to be useful, okay, first remember guys, what does mean by useful? Obviously, when we prepare financial statements and we present it to the public at large, so those financial statements must be useful for the decision makers. Obviously, if you are a shareholder, so you have to take decisions, either you should invest in this company or not, right or wrong. So that is why information will be useful. There are 2 points which you have to remember. We will consider that information is useful if information is relevant to the business entity, and plus it is faithfully presented. So this is what does mean by useful information. So they're saying the financial reporting to be useful, it must, like when financial reporting is useful, it must be understandable to those who have limited knowledge of business activities. No, it doesn't mean useful, as I told you, 2 words. It should be relevant to the business activities or business economic activities, plus it must be faithfully presented. So this is not the option. So then useful information, the information will be considered as a useful if it must provide information useful for making business and investment decision. Yes, obviously guys, being investors, you always need relevant information and you always need, faithfully presented information, like free from fraud. So this is actually the answer. It should provide useful information for the decision makers, right? This is the correct answer. So then they are telling you information is useful. It must directly measure the value of the entity. No. So value of entity is not the part of financial accounting. Like what is the value? Obviously, what is the value of the business? For this, we use always financial management, not the financial accounting. But in somehow in financial management, we can use discounted cash flows method to calculate the value of business. Price earning ratio, there are different methods are there. But value of the business, like they are saying, the financial reporting to be useful, it must directly measure the value. No, value of the being reporting entity. No, it is not the correct option because financial useful doesn't mean to measure the value of entity. Useful means to say relevant and faithfully presented. Then they're saying that for financial reporting to be useful, it must be in accordance with the generally accepted accounting principle. Guys, it must be. It is not necessary because sometimes there are departures. We can depart certain standards. Like for example, if your local laws are having contradictions with the accounting standards, so you can depart in that scenario, right or wrong. So it is useful doesn't mean it must be in accordance with the generally accepted accounting principles. No, it is not necessary. It must be in accordance with the gap. No, it means it must be relevant and it must be faithfully presented. So that is why option B is correct. Then we have next question. A primary objective of external financial reporting is what? What is the purpose of external financial reporting? Is direct measurement of the enterprise stock price? No. How to calculate the value of stock prices or value of business? It is not the part of financial reporting. It's not the objective of financial reporting. The objective of financial reporting is to provide information that is useful to present and potential investors, creditors, and others in making rational financial decisions regarding the enterprise. Yes, it is correct. The reason is that the purpose of the objective of financial reporting is to provide useful information to the decision makers. Decision makers could be potential investors, like those people who wish to invest in the stocks Creditors, those people who want to lend the money, or other stakeholders. So actually, this is the correct option. So the objective is to provide useful information. Useful, as told you, mean to say relevant and faithfully presented. Again, next, the primary objective of external financial reporting is direct measurement of the value business enterprise. No, our purpose is not to calculate the value. Again, the primary objective of external financial reporting is establishment of rules of accruing liability. No, it's not about only liability. So in accounting, we also treat assets and equity, expenses, revenue, etc. But our objective, this is the main objective, is to provide useful information. As I told you, useful mean to say relevant to the business activities and faithfully presented. So option B is correct. Then we have another question, the accounting measurement that is not consistent with the going concern concept. As you know, going concern mean to say, when we prepare financial statements, we always assume that our business will continue for the foreseeable future, right or wrong? So that is why due to this reason, we always categorize current assets and non-current assets, like which assets will be converted into cash, or which asset will provide you benefit within a year, which is current assets, or which asset which will provide you benefits beyond 1 year, that is non-current assets. So that is why we also classify current liabilities as non-current liabilities, because if your business is not going concern, or your business is going to wind up, then there is no point to show current assets or non-current assets, or current liabilities or non-current liabilities, because then all liabilities should be current liabilities, because it is going to, your business is going to close and you have to settle your liabilities. So that is why when the question is the accounting measurement that is not consistent with the going concern concept is liquidation value. I will explain this. Realization value, transaction approach, historical cost. Okay, guys, if you look at here, first let me tell you realization value. Realization value means, like, if you remember about the account receivables, account receivable we always record at NRV. NR means a net realizable value, which is always equal to gross receivables minus what? Allowances for receivables. So this is called NR. It means the realization value we use to measure certain assets. So it is correct option, but this is not the option of the question. The question is which accounting measurement that is not consistent, but this is consistent because the realization value we use in our financial statements. Then transaction approach. What is transaction approach? Transaction approach means to say, guys, we record revenue and expenses. We record all individual transactions, and then at the end we summarize the revenues and expenses in shape of financial, income statement, and we calculate the profit and loss value. So that is called transaction approach. Transaction approach means to say we record all individual transactions and then we summarize to see profit or loss. Yes, transaction approach is consistent with the going concern. Then we have a historical cost. Historical cost, guys, there are certain assets which we record on the historical cost. For example, it could be a non-current asset like property, plant, equipment, which we can record at historical cost. So, but when we prepare our financial statement and when we assume our business is going concern, we never use liquidation value. What is liquidation value? You should understand. Actually, this is the answer of the question, because the liquidation value is not consistent with the going concern concept. The reason, because going concern, we assume our business will continue in foreseeable future. But what is liquidation value? Liquidation value means say if you will close the business, what value you will get through the sale of assets. Obviously, we don't want to close our business. It means when we prepare our financial statements, we never use liquidation value. Liquidation value is what? If we close the business, what we will get through the sale of assets. So liquidation value is not consistent with the going concern, because liquidation means say we are going to close the business. Going concern means to say business will continue for the foreseeable future. Understood? So liquidation value is the answer, guys. This is not consistent with the going concern. Then we have another question. The general purpose external financial reporting. General purpose means obviously when we prepare normal financial statements of commercial companies, okay, that is called general purpose. Right or wrong? It's not a specific purpose. It's a general, like in general, whatever financial statement we prepare by applying US GAAP. or IFRS. General purpose external financial reporting of corporation focuses primarily on the needs of which of the following user. Like what they are telling you, basically general purpose financial reporting, okay, focuses primarily on the needs of which of the following user. Obviously, the main users are what? Investors and creditors and their advisors. Because board of directors, the purpose of financial reporting is not to facilitate board of directors. For management people, management accounting is more relevant. Okay, so our main purpose, the purpose of the general purpose financial statement is to provide useful information to investors and creditors. This is the option. Regulatory and taxing authorities, obviously regulatory and taxing authorities, they can use our financial statement, but this is not the primary purpose. They are the user, but this is not the primary purpose. Primary purpose is to provide information to investors and creditors who are financial straight, who are going to invest into the business. For again, the option is the management of the corporation. For management and the board, more management accounting is more relevant. I hope so guys it is clear. See you in the next video. And please also remember I'm going to upload couple of practice questions, videos, topic wise. Keep watching. Thank you so much. See you in the next video. Bye.